How do you lose $70 billion? Not over decades, not by slow decay. In a single, breathtaking implosion. In the year 2000, Enron was America's most innovative company. That's not hype. That's what Fortune magazine printed. The stock, $90. Market cap, $60 billion. The golden child of capitalism. By December 2001, it was worth less than a penny. Bankrupt, obliterated. And here's the thing nobody asks. It didn't fail because the markets crashed. It failed because its own executives figured out how to hide billions in debt using accounting tricks so elegant, so audacious, that they actually laughed about it. This is the story of how the system itself became the crime. Kenneth Lay founded Enron in 1985 by merging two natural gas pipeline companies. For a decade, it was just a pipeline company, boring. Profitable, but boring. Then, in the 1990s, Congress deregulated energy markets. Suddenly, you could trade energy futures, just like stocks or commodities. Lay hired a young consultant named Jeffrey Skilling. Skilling was brilliant, arrogant, and obsessed with one thing: beating Wall Street's expectations every single quarter. Skilling looked at the old way of accounting and saw weakness. You sign a 20-year contract. You record profit as you deliver. Spread across 2 decades. Skilling saw something different. He saw opportunity. He demanded Enron adopt mark-to-market accounting. It was revolutionary, dangerous, but perfectly legal. Here's the trap. You book the entire profit on day one. All 20 years of expected earnings. Today, $100 million contract. You record all $100 million immediately, instantly, before delivering a single unit. The problem was obvious. You had to actually make that money. And if you didn't, you had to find a bigger deal to replace it. Then a bigger one. Then another. Enron's revenue exploded. $13 billion in 1996. $100 billion by 2000. 750% growth in 4 years. Analysts couldn't explain it, couldn't trace where the money came from. That's not a bug. That's a feature. Nobody understood how Enron made money. Enron executives liked it that way. By 2000, Enron wasn't just a company anymore. It was a machine. A sophisticated engine designed to manufacture profit from thin air. But air doesn't hold weight. Air doesn't pay investors. Sooner or later, gravity wins. When Enron's risky bets went bad, and they always did, executives faced a choice: report the losses or hide them. They chose the third option. They moved them. Enter Andy Fastow, Chief Financial Officer, architect of the invisible. Fastow didn't invent anything new. He just weaponized accounting rules. He created shell companies, dozens of them, hundreds of them. They had names like raptors, named after Jurassic Park dinosaurs, JEDI, White Wing LJM-1, and LJM-2. Here's how it worked. Enron owned an investment losing $600 million. If investors saw it, they'd panic. The stock would crater. So Fastow created a company called Chuco. Chuco would buy the bad investment for $383 million. Using money Enron guaranteed. On Enron's balance sheet, the losing investment vanished. In its place, cash from an independent buyer. Problem solved. Except Enron still owed Chuco money, except Chuco was technically separate. So Enron didn't have to report Chuco's debt. It was like erasing a stain by moving it to a different shirt. The stain's still there. You just can't see it anymore. By 2001, Enron was layered with these phantom companies. $2 billion here, $1.2 billion there. Debt hiding debt, lies covering lies. The Raptors alone held $2 billion in Enron assets, assets that didn't exist, values that were pure theater. This wasn't fraud in the traditional sense. There were no bags of cash, no secret offshore accounts. It was something more elegant, more dangerous. It was hiding the crime inside the system itself. In July 2000, Enron signed a deal with Blockbuster Video. 20 years. On-demand movies delivered to American homes. Streaming before streaming existed. Enron immediately announced $110 million in profit. Except the technology didn't work. Market testing showed nobody wanted it, nobody ordered it. 8 months later, Blockbuster killed the deal. So what happened to the $110 million? It stayed on the books. Enron kept it as projected future earnings from a dead deal. An accountant later confessed, "We exploited that weakness in the rules. We tried to aggressively use the literature to our advantage." Translation: we lied, and the system let us. Mark to market wasn't just accounting. It was alchemy, turning nothing into earnings. In March 2001, something dangerous happened. A Fortune magazine reporter named Bethany McLean actually read Enron's financial statements. She asked, "Is Enron overpriced?" She noticed 3 things the system missed. 1. Trading at 55 times earnings. Absurdly expensive. 2. The financial statements were indecipherable. Nobody could explain where the money came from. 3. Despite massive revenue, Enron was adding debt at a frantic rate. Growing revenue while drowning in debt? That's not growth. That's a warning sign. Skilling's response? He called her unethical, accused her of not understanding the company. Fasto told her, "We have 1,200 different trading books. We don't want anyone to know what's on them. We don't want anyone to know where we're making money." That's not how legitimate companies talk. That's not transparency. That's concealment wearing a business suit. But Skilling and Fasto weren't worried. They believed they were too clever to get caught. They were wrong. August 2001, Skilling resigned as CEO. After 6 months, he cited personal reasons. His stock holdings suggested otherwise. He sold $33 million in Enron shares before stepping down. He knew something. When investors asked if anything would change, Ken Lay assured them, "There will be no change in performance or outlook." It was the last lie that mattered. Lay had no idea what was coming. Skilling had already left the building. The captain jumped the ship. The rats knew the ship was sinking. One day after Skilling resigned, a vice president named Sharon Watkins sent an anonymous letter to Kenneth Lay. She wrote, "I am incredibly nervous that we will implode in a wave of accounting scandals." Watkins had spent months investigating Enron's accounting. She was terrified. She had warned colleagues. They dismissed her. So she went directly to the CEO. In 6 pages, she outlined everything. Mark-to-market abuse, phantom shell companies hiding billions in debt, the entire apparatus of fraud. Our accounting practices are aggressively interpreted at best, and I would argue they are dishonest. She gave Lay a choice: fix this internally or watch the company implode publicly. Lay's response? He ordered Vinson & Elkins, Enron's own law firm, the same firm that helped structure the frauds, to investigate themselves. Unsurprisingly, they said everything was fine. Lay also wondered aloud whether they should fire Watkins. Silence the messenger. Eliminate the threat. An internal memo from Enron's lawyers explicitly asked, What are the legal consequences of firing an employee who raises accounting concerns? They decided not to fire her, only because they feared a lawsuit. Watkins was told her concerns had been investigated and addressed. Everything was okay. She could relax. She did not relax. She couldn't, because she knew. The implosion was coming. October 16th, 2001. Enron announced restatements. Earnings reduced. $613 million. Liabilities increased. $628 million. Shareholder equity wiped out by $1.2 billion. All the hidden debt suddenly visible. All the phantom profits suddenly gone. The stock dropped from $90 to $20 in a single day, then to $8, then lower. Banks stopped lending. Investors panicked. Enron was drowning. The company tried to arrange a buyout. Dynegy offered a deal. It seemed possible. Then Enron revealed more accounting problems. And more. The fraud went deeper than anyone realized. Dynegy walked away. By November, the stock was worthless, 61 cents, then pennies. Enron faced total collapse. December 2nd, 2001, Enron filed for Chapter 11 bankruptcy. $63.4 billion in assets. Gone. Largest bankruptcy in American history. 20,000 employees lost their jobs. Thousands lost their retirement savings, their lives. Some employees lost 90% of their 401k's decades of savings. Erased. Shareholders filed a $40 billion lawsuit, eventually recovered $7.2 billion. An 82% loss. Ordinary people who believed in the company, who trusted the executives, who had no idea the system was rigged. Kenneth Lay was convicted but died of a heart attack before sentencing. Jeffrey Skilling was sentenced to over 24 years, later reduced to 14. Andrew Fastow pleaded guilty. 10 years in prison. Arthur Anderson, the accounting firm. 89 years old, convicted of obstruction of justice for shredding documents. The firm ceased to exist. One scandal destroyed an institution that had survived the Great Depression. The collapse was that catastrophic.